On June 10th, a company most people have never heard of wrote a check for up to $1.4 billion. Not to a bank, not to a fintech, to a robotics company in a small town in southern Germany called Metzingen. And the reason they gave for writing it is the strangest sentence I've read all year. Here it is, word for word, from the chief executive who signed it. Autonomous machines need the ability to process information locally, make decisions, and transact without relying on centralized intermediaries. Read that again. Machines need to pay each other, and they can't open a bank account. Now here's the part almost nobody connected. The man who wrote that check runs the same company that in a single 30-day stretch this spring blacklisted 370 addresses and froze $514 million of other people's money. Same company, same quarter. $1.5 billion out the door to build money for robots, $500 million frozen on the people already using it. Those two facts are not a contradiction. They're the same story. And that story is about the number sitting in your savings account right now. Let's start with you, because that's who this is actually about. You did the responsible thing. You built a cash cushion, emergency fund, maybe more than that, sitting in a savings account or a CD or a money market where it can't get hurt. And every single year, quietly, it gets smaller. Not the number stays fine. The number might even go up a little. What gets smaller is what the number buys. Here's the picture I want you to hold for the next 25 minutes. Imagine a yardstick. You've got a room, and the room is exactly 10 yardsticks long, and you go to bed. Overnight, somebody sneaks in and shaves an inch off the yardstick. You wake up, you measure, and now your room is 10.5 yardsticks long. Congratulations, your room got bigger. Except it didn't. Your room did not move a millimeter. The ruler moved. That's inflation. It isn't a thermometer measuring the economy, it's a ruler, and somebody else owns it, and they get to decide how long an inch is this year. And they've been shaving. Which brings me to a question worth actually answering, and it's the one you typed into a search bar to get here. How do you protect savings from a ruler you don't control? I'm going to give you the honest answer, and I'm going to start it by taking something off the table, because if I don't, you shouldn't believe the rest of it. Before I do one thing, there's a 2-minute thing I built that shows you what inflation is quietly costing your particular pile of cash, in dollars, per year. Not the national average, yours. I'll tell you where it lives in a bit. Right now, stay with me, because the next number is the one that changes how you think about all of this. On January 2nd, 2013, one Bitcoin cost $13.09. On November 29th of that same year, it closed at $1,132. That's 86.5 times your money in 331 days. Let me put that in a shape a human can feel. That's 50% a month, every month, for 11 months straight. $10,000 became $865,000 before the next Thanksgiving. You are not going to get that trade. I want to be extremely clear, because this is where every other video lies to you. That trade is gone. It is not coming back. Anybody who tells you Bitcoin is about to do 86 times again inside a year is either selling you something or hasn't done the arithmetic. And I know how that sounds coming from a guy who talks about Bitcoin every week. I'm aware I sound like the world's worst salesman. My wife has mentioned it. And here's why, and it has nothing to do with Bitcoin being worse. In January 2013, all the Bitcoin in the world added up to about $139 million. That's not a typo. Million. That's a mid-size apartment complex. That's one decent grocery store chain. Today, it's 1.3 trillion. The base is roughly 9,300 times bigger. So run the 86 times from here and see what breaks. 1.3 trillion times 86 is $112 trillion. Now, The total value of every publicly traded company on planet Earth, every stock on every exchange in every country, is about 152 trillion. So an 86x from here would make Bitcoin roughly 74% of all the world's stock markets combined in a year. That's not an investment thesis. That's a fantasy. That trade isn't gone because Bitcoin got worse. It's gone because Bitcoin got big. Now, take a breath, because I just took away the exciting part on purpose. What's left is the part that actually applies to a 63-year-old with real money and a real timeline. And it's better than the fantasy because it's true. Back to your savings account. Here's the thing nobody frames correctly. When you look at a savings account, you think the risk is losing the money. Bank fails, market crashes, number goes down. That's not the risk. The number is almost never going to go down. The risk is the denominator. Your cash isn't measured in cash, it's measured in what cash buys. And that's a decision somebody else makes in a room you're not in. Think about a football field. You're standing on the 50-yard line, and you feel pretty good because you're halfway there. Then the groundskeeper repaints the field overnight and moves the end zone back 40 yards. You didn't move. You didn't do anything wrong. You just have a lot further to walk than you did yesterday, and nobody sent you a letter about it. Every dollar you own is a claim, and every claim has somebody on the other side of it who can create more of the thing you're holding. That's not a conspiracy. That's the design. It's written down, it's public. It's the job. And here's where it stops being an abstraction and starts being your Tuesday. If the ruler shrinks 2 or 3% a year, and your savings account pays you less than that, you are paying a fee to keep money safe. You're just not getting an invoice. So the obvious question is, fine, where do I put it instead? And that's where this gets interesting, because the people building the next financial system have been answering that question out loud. Just not for you. Come back to Metzingen. Tether Investments, the company behind the largest dollar substitute token in the world, led a funding round of up to $1.4 billion into a German robotics company called Neura, announced June 10th of this year. Why does a money company buy a piece of a robot company? Their own announcement says it plainly. The robots will, and I'm quoting, receive payment for completed tasks and execute transactions within predefined operational parameters. And then the line that should stop you cold. Settlement becomes part of the workflow itself rather than a separate human-managed process. Let me translate that out of the press release and onto your kitchen table. Right now, when work gets done, a human gets paid. And the paying is a separate event. You do the job, then somebody cuts a check. Then a bank moves it, then it lands. What they're describing is a world where the paying is inside the work. The machine finishes the task, and the money moves in the same motion. No invoice, no bank, no human in the middle. And here's the thing about machines. A robot cannot walk into a branch with two forms of ID. It can't have a social security number. It can't be sued. It can't be a signer. It can't pass a know your customer check. So the entire banking system, every rail your money rides on, structurally cannot serve them. Which means somebody has to build machines money that doesn't need a bank. And $1.5 billion just said that out loud. Now, I've been saying this on this channel for a while, and I want to be honest that I said it as a guess. The machines are coming, they'll need to transact, and they can't use the plumbing we use. That was a hunch. It stopped being a hunch on June 10th. The largest stablecoin company on Earth put $1.4 billion behind it and wrote the reasoning down. So the future of money is digital, and it settles without a middleman. Fine, that's decided. The only question left is which digital thing they hand you. And that answer is the whole ballgame for your savings. That number I mentioned? What the shrinking ruler is costing your specific pile of cash. The 2-minute quiz on my macro command center at timtalksfinance.com/members gives you that in dollars per year. Free, no credit card. Here's the answer to the question I opened with. And it's the reason those two Tether facts are the same story. The money they're building for the machines is a token called USDT. It's designed to be worth $1. It moves in seconds, settles anywhere, doesn't need a bank, and it has a freeze button. In one 30-day window this spring, Tether blacklisted 370 addresses and froze $514 million. Separately, the company has confirmed freezing more than 344 million more, working directly with the US Treasury's Sanctions Office and American law enforcement. I'm not telling you those freezes were wrong. A lot of them were stolen funds and fraud proceeds, and I'd want that money frozen too. I'm telling you the button exists, and it works, and somebody's finger is on it. That's the reveal, and it's bigger than one company. They are going to tokenize everything. Your house, your bonds, your fund shares, your car title, your savings. That's not a prediction, it's a build schedule, happening in public, with legislation and infrastructure and billion-dollar checks. And every single one of those tokens still has a man who can make more of it, or switch yours off. A tokenized bond has an issuer. A tokenized house has a registry and a county recorder. A dollar token has a company in the Caribbean with a compliance desk. A central bank digital currency has, well, a central bank, plus the ability to decide what you're allowed to spend it on. Every exit they're offering you has an owner. I learned that in the most boring way possible. I spent my career in mortgage lending. I was writing loans in 2006 when the industry was selling adjustable rate products I could prove made no sense. And I opened my own mortgage company in 2018. Years back, I had a client from Dubai buying a $1.5 million condo, putting about $500,000 down, and the down payment was in Bitcoin. Fannie Mae wouldn't take it, treated it essentially like drug money. So I sat down with my underwriter and I didn't argue with her. I showed her the ledger. A public ledger, same idea as the private one every bank keeps, except anybody can read this one, and nobody can quietly edit it. She went and checked it herself. Then she made her own call. The funds were clean. That's the whole thing right there. Verification instead of trust. She didn't have to believe me. She could look. Every other asset on that list requires you to trust somebody. There's always a man. Except one. 21 million. That's it. That's all there will ever be. Not a target, not a policy, not a committee vote that could go the other way next quarter. A rule and a protocol that tens of thousands of independent machines enforce, and that nobody has been able to change in 17 years of people with enormous incentives trying. And here's the number I don't think enough people sit with. 20.07 million of those 21 million already exist. 95.6% of all the Bitcoin that will ever be mined has already been mined. The Bitcoin supply question is essentially over. It was answered while most people were arguing about the price. There's no issuer. There's no company. No one to call, no one to lobby, no one to freeze your address, and critically, no one who can make more of it because it would be convenient. And I want to slow down on that word, issuer, because it sounds like accounting jargon, and it is actually the entire difference. An issuer is just somebody with the legal power to create more of the thing you're holding. Your dollars have one. Your bonds have one. The shares in your retirement account have one. Companies issue new stock all the time, and your slice quietly gets smaller. Even the deed to your house sits in a registry that a county can amend, and a lien can be attached to, and a court can move. Every one of those is a promise from an institution. And a promise is only as good as the institution's incentives on the worst day it ever has. Bitcoin isn't a promise, it's a rule. And the rule is enforced by tens of thousands of independent computers that would all have to agree to break it, against their own interest, at the same time. That's not trust. That's arithmetic. Now put that next to the size of the thing that's about to move. Depending on who's counting, somewhere around $900 trillion of the world's wealth is parked in store of value assets. Real estate, bonds, equities, gold, cash, collectibles. All of it is being rebuilt onto digital rails right now, in public. You don't need a wild assumption about where that goes. You only need to ask what happens if even a modest slice of it looks around, notices that every option on the menu has an issuer, and lands on the one that doesn't. Divide a slice of 900 trillion by 21 million coins, and you get the numbers people call insane. They're not insane, they're just division. Whether that migration actually happens and how fast is the honest, open question. It is not a certainty, but it's the question. And Bitcoin is the only asset on the board where the answer isn't capped by somebody's willingness to print more. That is the entire argument of this channel, and it fits on a napkin. In a world where everything is about to become a token, the only token that matters is the one nobody can print. That is Bitcoin. Now that's a big claim, and the fair response is, okay, but why Bitcoin specifically? Why not something else with no issuer? So let me walk the alternatives because I went looking for a better answer than Bitcoin for a long time, and I couldn't find one. Start with gold because that's the honest first stop for anybody over 60. Gold has no issuer either. Nobody prints gold. It survived every currency that ever tried to replace it, and it's up enormously. Gold is not a stupid answer. Here's where gold runs into a wall. Gold can't move at the speed of the internet. To use gold in a digital economy, somebody has to hold the actual metal and issue you a paper claim or a token that says the metal is there, which means gold needs a ledger. And a ledger needs somebody you trust to keep it honestly. And that's the whole problem again. You didn't escape the man, you just moved him into a vault. Gold is the on-ramp. Bitcoin is where the on-ramp goes. Then there's a central bank digital currency. Same disease, worse coat. Unlimited creation, exactly like today, except now the issuer can also see every transaction and can decide what you're permitted to buy with it. That isn't a competitor to Bitcoin. That's the thing Bitcoin was invented to make optional. Then there's the dollar token, the USDT we just talked about, and everything like it. Fast, useful, genuinely convenient. And it has a compliance desk and a freeze button, and it holds its value by holding dollars, which means it inherits the shrinking ruler by design. A stablecoin isn't an escape from the yardstick. It's the yardstick, with better shipping. And then there's the rest of the crypto market, which I'll be blunt about. Thousands of tokens, almost all of which have a founding team, a treasury, and the ability to create more. If somebody can make more of it, it is not the answer to a problem caused by somebody making more of it. That's not a Bitcoin opinion, it's just logic. One coin. That's this whole channel. So the list next to Bitcoin is short. Gold needs a trusted man. A CBDC is the man, with a camera. A stablecoin has the man's phone number. Everything else has a founder. Bitcoin has nobody. 21 million, 95.6% already issued, enforced by math instead of by promises. There is no third door. I've looked. If you find one, genuinely, put it in the comments and I'll make a video about it. I'd rather be corrected than be wrong for another decade. Now let's do the honest math, because I told you I wasn't going to sell you a fantasy, and I meant it. Bitcoin is $64,940 as I record this. Its all-time high was $126,080 back on October 6th of last year. So it's down about 48%, cut roughly in half. There is real fear right now, and I'm not going to pretend otherwise. And if you buy Bitcoin tomorrow, it can absolutely go lower. That's not a caveat I'm burying at the bottom. That's the actual deal. But here's the thing that took me a long time to understand. And it's the answer to how you protect savings from a ruler you don't control. The volatility is the price of admission. It's not a bug in the asset. It's the toll you pay to own something with no issuer. If Bitcoin moved like a savings account, it would already be priced like one, and the opportunity would be gone. The reason a door is still open is that most people cannot stomach watching it get cut in half. And I want to be fair to that 2013 buyer for a second, because I've been using him as the guy who got lucky, and that's not the whole story. That man did not sit peacefully on 86 times his money. Bitcoin fell roughly 80% after that peak, and it stayed down for 2 years. 2 years of every headline calling it dead, every relative at Thanksgiving asking how the internet money was going, and a number on the screen that had taken most of it back. Almost nobody held their Bitcoin. That's the actual reason so few people got that trade, not because it was hard to find, but because it was unbearable to keep. So when I say the volatility is the toll, I'm not being poetic. The toll is paid in years of looking stupid. A 48% drawdown feels terrible right now because it's supposed to. That feeling is the fee, and it's why the asset is still available to somebody with a 20-year horizon and a strong stomach. Here's the version of that for a man with a mortgage payment and a spouse who reads the statements. You do not put money into Bitcoin that has a job in the next 5 years. Not the emergency fund, not the roof, not the thing your wife is counting on. Money with a deadline doesn't belong in Bitcoin, or anything else that can be cut in half on a Tuesday for no reason you'll be able to explain at dinner. Now compare the two things honestly. The classic retirement portfolio, 60% stocks, 40% bonds, has returned about 9.1% a year, nominally, going back to 1926, nearly a century. That is a genuinely good, genuinely proven number, and I'm not here to talk anybody out of it. Against that, the long thesis on this channel is that as the world's store of value wealth migrates onto digital rails, a meaningful slice lands on the one asset with no issuer, and a single Bitcoin ends up somewhere in the $7 to $10 million range. From 65,000, 7 million is about 108 times your money. Wait a second. Didn't I just spend 5 minutes telling you that 86 times was a fantasy? I did. And here's the difference, and it's the most important sentence in this video. It was never the multiple that disappeared. It was the speed. The 2013 buyer got 86 times in 11 months. 108 times spread over 20 years is about 26% a year. Over 25 years, about 21% a year. 26% a year is an extraordinary number. It is not a physically impossible number. 9% a year is the proven one. That's the actual comparison. Not get rich, not moon. Two numbers, both of which you can check, over a timeline you can actually live in. And there are no certainties here, only probabilities. That thesis could be wrong, the migration could not happen, or it could take 50 years instead of 20, or a government could make owning it miserable. I'm handing you the math, not a promise. But I'll tell you what I know for certain, because it's the only certainty in this entire video. The ruler is going to keep shrinking. That one isn't a probability, that's the design. Cash in a savings account is the only position on this list where the loss is guaranteed and just paid slowly. You're not trying to get rich by Christmas. If you're 63, that was never the point. The point is not being poor in 2040. So here's what I'd actually do with this, and then I'll get out of your way. Don't do anything today. Go look at the arithmetic yourself. Find out what the shrinking ruler is costing your specific savings in dollars this year. Then look at Bitcoin, not the price chart, the supply schedule. 21 million, 95.6% already issued. No company, no printer, no freeze button. Then decide what percentage of your money you want sitting in something nobody can make more of. It might be zero. That's a legitimate answer. But make it a decision instead of a default. Because right now, doing nothing is also a decision. It's just one somebody else is making for you, 1 inch at a time, off the end of a yardstick. That first step, the number for your own cash, is free. Go to timtalksfinance.com/members, take the 2-minute quiz, and it'll show you what inflation is actually costing your savings per year in dollars, plus one move worth considering for your situation. No credit card, no sales call, about 2 minutes. I built it because I got tired of watching people find out about the yardstick 20 years too late. They told us the future was stolen. It wasn't stolen. It was repositioned. Moved out of the thing you were told to save in and into the thing they're quietly building the rails for. You can still get there. You just have to walk through a different door than the one they keep pointing at. I'll see you in the next one.